You're listening to a CNA podcast.
Is the recession really coming? Yes or no?
I think so.
3 words when you think of a looming recession.
Buy more stocks.
Describe recession-proof stocks in a single sentence.
They're stable business who can still perform during a recession, and their share price is likely to lose less if the market is crashing.
Top 3 types of stocks to invest in during a downturn.
Supermarkets, healthcare, education.
Investing mistakes to avoid in a recession.
Move your money into safe yielding assets, principal guaranteed, but then miss the run when the market starts to be bullish again.
The big R word. It's been uttered so many times this year, striking fear even in the most seasoned economist. But while a recession hasn't quite yet arrived, perhaps it's not too late to look at adding some resilience instead to your portfolio. Hi, I'm Andrea Heng, and this is the Money Talks podcast, where we talk about your money and the many wonderful things you can do with it. So previously, we asked ourselves, is it still worth putting your money in Singapore's treasury bills and savings bonds this year? Well, if you want to know the answer, look out for that episode on Spotify or Google Podcasts. Just search Money Talks and you'll be on the right track. But back to the dreaded R word, recession. It was a buzzword at the start of the year when the world was dealing with a number of unfortunate events, staggering inflation, sky-high interest rates, and geopolitical conflict, all of which are sadly ongoing even today. So we're asking, how can we protect ourselves from a recession if it does arrive? Are there changes we need to make to our stock portfolio so that the sting will be less painful? Here to chart a path for us is Alvin Chow, CEO and founder of Dr. Wealth. Thanks for joining us on Money Talks, Alvin.
Thanks, Andrea. Thanks for having me.
Okay, so in Singapore, we understand that a technical recession is 2 consecutive quarters of GDP decline. But outside this definition, what are the conditions of a recession we need to take notice of as an investor? What are the warning signs we should be looking out for?
So as you rightly pointed out, the Singapore economy did avoided a technical recession because the second quarter was actually a positive GDP growth. And I would say that looking at a bigger economy, the US economy is definitely the one that we need to watch out for because it affects the rest of the world, right? Being the biggest economy in the world. And for the US side, actually the economy seems a lot stronger than predicted. They have 2 consecutive quarters of positive GDP growth this year so far. And it seems like the US economy is absorbing the high interest rate rather well, right?
Oh.
To a lot of people's surprise. But one of the key signs that I look out for is actually this thing called the yield curve inversion.
Okay.
So this yield curve inversion is basically taking the 10-year bond yield minus away the 2-year bond yield.
Okay, and what does that do?
So by right, a longer 10-year bond should give you high interest rate.
Right.
Just like if you buy a 10-year bond, you expect high interest rate than a 2-year bond, right?
Sure.
So which means a 10-year minus a 2-year yield, it should be a positive number.
Oh, yeah,
Right?
that makes sense. Okay.
So when the yield curve inverts, that means that the 10-year yield is actually lower than the 2-year yield. That is where you get a negative number, and that's what the economists term as a yield curve inversion.
Okay.
And historically, this indicator, whenever the yield curve inverts, recession is around the corner.
Oh, and where are we at if we're looking at the yield curve now?
It has been inverted for more than a year.
Okay.
So one thing is that it's not immediate. It doesn't mean that, the moment that this yield curve inverts, the recession is going to happen tomorrow.
Okay.
It doesn't. There is a delay. It can be 1 year, 2 years. So we are not exactly out of the woods yet.
Right.
Even though the economy looks okay now, but we wouldn't know for the second half of the year and probably first half of the next year.
Right.
We may see a recession. So it's still in the cards.
So it may not signal a recession immediately, but it may also not signal a recovery immediately.
Yes.
Okay.
And there can be false signal as well. It is not 100%, but I would say that based on the historical track record of this yield curve inversion, it's definitely more than 50% accurate.
Okay.
So there is still a higher chance that a recession may happen.
Okay. May, that's the key operative word. So while there may not be a recession yet, markets have deteriorated around the world. I mean, we've seen it. It's a bloodbath in some cases. I guess that tends to mean cheaper stocks, or is that too simplistic a way to look at it?
There are a lot more complication if we look into the details.
Sure.
So for example, definitely 2022 was a bad year for stocks all around the world. Even in the US, it crashed.
Especially for tech.
Yes, especially for tech. Those that were sensitive to interest rates were all getting hammered. And this year is a little bit different because the US stocks have been doing pretty well.
Yeah.
Even the recent correction, S&P 500 index is still up about 16% year to date.
Oh, that's impressive.
Yeah.
Okay.
And Nasdaq is probably up more than 20% year to date. So I guess a lot of people didn't expect that to happen. Right? We're just back off a very high interest rate, and it doesn't seem like in the near future the Federal Reserve is going to cut interest rate anytime soon.
Oh no.
Right? So it is surprising that the market has went up.
Yeah.
Okay.
Yeah.
And I think this is what most people find it difficult to understand. Okay. If let's say
I do.
Yeah, exactly, right? So if the economic condition doesn't look that good, why is the stock market going up?
Correct.
So historically, again, there isn't much correlation between the stock market and the economy, right? It sounds a little bit weird, right? But the correlation is almost zero.
Really?
Yes, it's almost
Okay,
zero.
explain this to me.
And the reason is because the stock market is usually a forward-looking system.
Okay. Kind of like a futures.
Yeah, it will price in future expectation
Got it.
earlier. Okay, so if you expect a recession is coming, so people will sell stocks now. There's this time lag, right?
Got
And the stock market is the leading indicator. And if we look at the economic indicators, right, it's usually lagging and delayed. For example, in August, we only get the July numbers.
Yes.
Somebody need to compile the report, and then the boss need to vet.
Because we haven't implemented AI into our compilation systems yet.
And the moment they released it, it's already water under the bridge. Okay? It's past month. Okay, but the stock market have already adjusted by then.
Right.
So that is why there isn't a very strong correlation. It's not that they have totally no relation. There is. It's just that the stock market is front running all this information.
Got it. So it's anticipatory rather than reactive, you're saying. So we're still on the edge of our seat. We're still biting our nails, waiting for the shoe to drop.
Yeah.
Okay. Would you say then that this is a favorable time to buy stocks, considering they are, I guess, cheaper or lower priced at this time?
There are definitely pockets of opportunity. Like, for example, this year we talk about the rally in US stocks. It is mainly driven by the AI side of things, right? Which means that there can be quite a lot of other sectors that are overlooked and have yet to recover. There can be some opportunities over there.
Okay.
And of course, investors also have to look at what is their investment horizon. I would always advocate that if you have a long-term horizon, right, it actually makes sense that every time you have some capital to invest, you should just go ahead instead of really timing the market, because you really will know. If it's low, you buy more, right? If it's high, you buy less. But it's that consistency that really build out the wealth.
So in a downturn, we tend to turn to safe haven assets. So your gold, silver, your precious metals, even property. Sometimes it's currency as well. Are these worth the buy-in at this time? And what kind of returns are we looking at when the market does recover?
Generally, I don't think alternative investments are better than, say, stocks for the long run. And some of the names that we mentioned have specific characteristics.
Okay.
For example, if you want to buy gold, you are actually betting against a weakening US dollar. You're
Okay.
indirectly shorting the dollar
Right.
because the gold is priced in dollar. And gold price tends to go up if the US dollar weakens and vice versa.
Right. So should I wait for the US dollar to strengthen, then I go and buy my gold?
It's almost like you're betting on a forex. Right? You're betting on US dollar strength. And the US dollar strength then in turn is related to whether the Federal Reserve is hiking rates or cutting rates.
Right.
So you can see it's a whole big macro mess that you need to figure out.
It's such a domino thing.
Exactly.
Right.
So gold itself doesn't have value unless people believe there's value. And historically, it's been seen as a store of value, right? Because it's seen as money.
I mean, it's the thing that my mom goes to lah.
Yeah. Until USD came about and delinked from gold and became a fiat currency. But yet, because gold is still priced in US dollar, that relationship is still there.
Right. So that's where the value in buying gold, so-called, lies, right? Is in the USD valuation.
Yes, exactly. So the decision to buy gold or not is really relies on the macro analysis, which I think is not easy to get right. Even economists don't get it right.
No,
I don't think the man
I mean,
on
if
the street
someone
is
got
easy.
it right, we'll be set for our lives, right?
Yeah. So I would say that conventionally, I would still believe that stocks are one of the best long-term investments out there.
Okay.
Because even historically, the returns have been better than if you just buy gold.
Okay, so let's get into the nitty-gritty of that. Let's first try and define what it means to be recession-proof. Is there such a thing? Should we call it recession safe instead?
I think a better word is defensive.
Recession, defensive.
Defensive stocks rather than like recession-proof
So
stocks.
don't frame it as under the recession conversation.
Yeah, and defensive doesn't mean that you cannot let the opponent score a goal. You still can, but at the end of the day, you want to win the match, right? So you win 2-1, it's still...
Nice analogy there. Nice analogy. You have to take some hits, but it doesn't mean you don't win the game, the long game.
Yeah, so for example, in the context of stocks, right, which means that if you buy defensive stocks, and if the market crash happens, it doesn't mean that your stocks won't go down.
True.
Right? It's possible that you can go down, but if your stocks go down less, maybe down 5%, other people's stocks were down 30%, you relatively feel good, right?
Yeah.
Even though
I
you
lost less
money,
than you.
I lost less than you. Yeah, so...
No, it's true though. It is true. It is true.
So I would say that having that defensive maybe is a better word than recession-proof.
Okay, so we will go with that term, defensive stocks instead. So what are the characteristics then of stocks and investments that are defensive?
Intuitively, people will always think of defensive as sectors or businesses where people will still demand their products and services.
Okay, so
even
your
during a
FMCG
recession.
goods sort of thing?
Yeah,
Okay.
groceries, you'll still go supermarket. In fact, you'll go more because restaurant will be too expensive. So you go and buy food to cook at home.
That's true.
So supermarket business might even go up rather than go down.
So would something like your electricity companies, your utilities,
Yes.
basically.
Anything that people would still use the product and services during a recession.
And what else outside of that segment can we look at in terms of defensive
Healthcare?
stocks?
Healthcare, I would think so, right? Because if you're ill, you're sick, you have to see a doctor.
I think
regardless
especially in
whether-
Singapore where we are driving towards healthier aging, that sort of stuff. So there's longevity in that,
Yeah,
right?
yeah. Or even aging homes, right? Because you can't stop aging because it's recession, right? So,
Yes, that's
so
true.
there are businesses like this that are pretty immune
Okay.
to the economic ups and downs.
Right, because it's a need and not a want. What about things like REITs? I know S-REITs tend to be quite popular in Singapore.
REITs can be a little bit more cyclical. Of course, it depends on the type of properties that they have.
Sure.
But if we generally look at it, like for example, your industrial definitely is cyclical. In good times, you have more people renting spaces because they have more business, they have more stuff moving around, they have more stuff to be produced. Same as office, right? Because if the times are good, people expand and they need more office space. And
Well, office spaces haven't looked good in a while.
yeah, exactly, right? So they tend to be more cyclical and sensitive to interest rate. So that's another side of the story. But there are healthcare REITs. They are definitely a lot more resilient.
Okay, and what about stuff like aviation? Is that something that we can look at as well? Hospitality?
I think at this point in time, the tourism theme is coming back and we have yet to recover to pre-COVID numbers for tourism, which means there can be some room for growth, but they are definitely not defensive. If recession comes, you tighten your belt.
Or another pandemic?
Yeah, you will not think of travel. Okay?
Yeah.
You buy your food, but you may postpone your travel.
Yeah, and also considering how we're living in such inflationary times, people are a bit more, I guess, thrifty when it comes to their money for luxuries like traveling, right?
So they are definitely not defensive. But if
okay.
economy continue to be good and picked up, then I believe tourism will do well.
Hello everyone, my name is Alvin Chow, and I'm host of CNA's weekly news podcast, Heart of the Matter. Each week, my job is to ask the questions you have, like why is the COE so high? Why aren't singles dating? Or what's going on with the red-hot property market in Singapore? If you want the views behind the news, then tune in each week as we get to the heart of the matter. We are on the CNA and Me Listen apps and wherever you get your podcasts. Hit follow or subscribe so you don't miss an episode when it drops.
So apart from just buying lower price stocks, which seems to be the theme that we're going for now, there are some segments that can weather a recession better than others, right? So what would some of these be in your view?
I think the other way to look at it is not to just look at sectors or businesses in terms of what we have discussed so far, but to look at certain characteristics of the businesses. For example, we can evaluate whether a business is defensive by looking at how it performed in the past. Because if there is a recession coming, it's not going to be the first one.
Oh, yeah.
There are many, many recessions before.
Yeah.
So we can definitely look at certain stocks by looking at their past performance during the last recession, maybe
Okay,
in
so company
2008.
fundamentals matter here.
Yeah. Did they cut dividends? Did they cut revenue? Did they cut profits? Did it decline? And if the share price go down, how much do you go down relative to other stocks?
Right.
So then we know that there is some proof whether this stock is indeed defensive or not.
Right. And basically, you're looking at the power of the rebound of that stock.
Yeah.
Okay.
So that would give us some sensing how it would perform if the recession comes.
Okay. So if these stocks tend to be more resilient against recessions, what would be their vulnerabilities? And surely there are some weak points because it can't all be rosy all the time, right?
The bad thing about defensive stock is that, okay, they do relatively better during a recession, during bad times.
Okay.
But during good times, they underperform
Okay.
because they tend to be very stable, steady, right?
Right. So they just stagnate.
Yeah.
So they don't grow much more.
They don't enjoy the boom when it comes.
Ah.
So when the boom comes, that's where the risky stocks will outperform. And for some investors who are holding on to the defensive stocks, and they will be feeling like, oh, my friend, my neighbor is making more money than me. I cannot take it anymore. I need to sell my defensive stock and get into those exciting stocks. But that's where the problem happens. Because when you feel that excitement, likely it might be near the end. Because everybody has made their money.
Exactly.
Who is going to buy from
By
you?
the time you realize, I could have been making more money out of this, your time in that market is too late.
Yeah, so my guess about this problem with defensive stock is that they don't prosper during good times and people might lose patience on them.
Okay. Are there other weak points?
Like every other business, even defensive stocks, sometimes their business can deteriorate. Their fundamentals can go poorer over time, which means that if an investor picks some of these businesses or stocks, the constant monitoring is required. Right? Time to time may not be a daily monitoring, but every year, maybe, like a spring cleaning, you need to look at your stocks. My observation over the years, looking at investors, they have a tendency to buy, but they don't have tendency to sell.
Yeah, they hang on to it like out of some strange loyalty, and I've always been intrigued by that psychology. Do you have any observations on that?
One is definitely loss aversion, right? Because it's painful to sell at a loss. It's easy to sell something that has gained, like 10%. Sell it, wow, feels so good, right? But sell this 10% loss, but if I sell it means I lose money. If I don't sell it, I still have hope that it might come back up. This kind of mentality.
Yes.
Yeah.
Do you think that kind of mentality is healthy?
It definitely is not that good for an investor because the fact is that no one can pick stocks 100% correct all the time.
Yeah, just
We
like
will
how
make
economists
mistake.
don't always get the forecast right. Yeah.
Even Warren Buffett. But he is honest about it and he's able to sell even at a big loss, right? Millions of dollars. He will take that loss and he'll move on.
Yeah.
So that is a necessary part of spring cleaning, right? You need to keep your portfolio clean. If I can use an analogy, right?
Sure.
A portfolio is like a garden.
Okay.
Of course, you want to have as many flowers as possible, right? That
Sure.
resemble your gains, right?
Yeah.
But we cannot guarantee a garden will always have flowers.
Mm-hmm.
There will always be weeds.
Yeah.
And what do we do with them?
We got to get rid of them.
We're going to get rid of them, right? So these REITs represent those stocks that should not be in a portfolio,
Okay.
but people don't. They keep it and they hope that the weeds can turn into a flower one day.
It's
Right?
like
So-
hoarding for the wrong reasons.
Exactly. So if we use that analogy, the investor behavior just doesn't make sense.
Yeah, you're right. So you did mention the kinds of homework we need to do before we buy into a company's stock. So company fundamentals, historical performance. What about fund baskets that comprise these so-called safer, more defensive stocks? Are these fund baskets an option if I don't want to buy individual stocks? And if yes, what are the pros and cons to them?
I would definitely suggest that majority of people should buy into funds or ETFs, right? Rather than picking an individual one. As we have discussed, it's a challenging task.
Oh, yeah.
You need to pay attention and you need to know your stuff. Otherwise, it's going to be difficult.
So what do we need to understand overall when it comes to buying defensive stocks in terms of returns, timing, time in the market?
I would think that a lot of defensive stocks appeals to a group of investors that tend to be more conservative. So I guess that people who are listening into this podcast have already self-selected themselves and they look at the word defensive, they come in because they are more risk averse. Those who are aggressive investors, they look at this like,
We should run a poll after this episode comes out.
Right? It's like defensive is boring.
Yeah.
I need to get rich quick. This is too slow for me.
Yeah.
And these defensive stocks also have the connotation that it's a boomer kind of stock.
Yes.
So I would also assume that the audience who are tuning in tend to be older and more risk averse at the same time.
Actually, sometimes women too. Apparently, the psychology of women when they invest is that they are in it for the long term. They just want to do this and then not think about it for the rest of their lives until it's time to cash out.
record shows that female investors are actually better than male.
There we go.
Yeah, because the male takes too much risk, so they
Right.
lose more.
Yeah. So, what mistakes do you think we should avoid when buying into the defensive stocks in the market?
One of the key things that potentially may harm a defensive investor is that they think that defensive stocks are safe. But in my opinion, there are no such thing as safe stocks. Even defensive stocks have their risk. And the worst is that you think that you buy it, you will not lose money, and the share price come down and you panic.
Yeah.
Right? And then you
Yep.
don't know what to do, which means it's a problem with expectation and reality. And I don't think that people should go away with the idea that defensive stocks are safe.
Guaranteed.
They are definitely not as safe as your CPF. They are definitely not as safe
Yes.
as your investment grade bonds that can return you the money at the end of the maturity, right? Your principal guarantee, your fixed D, or this. So it definitely will have a risk that is higher than what most people are used to putting their money in the banks and treasury bills and such. So they need to be able to understand that volatility can happen, which means that you buy a defensive stock, it can still go down 10%.
Because a defensive stock is still a stock.
It's still a stock. So it's still affected by the general market sentiment.
Mm.
The stock market may go down 50%, for example. Maybe your defensive stock can still go down 20%. Okay, and you must be ready for it.
Let's talk about an exit strategy. So we've bought some defensive stocks, we've diversified our portfolio, we're looking good. What should help us decide when to exit the market? Is this when the economy improves?
If there are conservative investors out there who pick up these defensive stocks, right, I would believe that it makes more sense for them to just stay for the long haul.
Okay.
And don't get tempted during good market times where the exciting stocks are running a lot. Because if at that point in time you switch, it's going to make matter worse. So having that stability in your portfolio, that consistency, maybe hold for 5-10 years. And I think that is a better way for conservative investors.
I think the affordability of taking the hit is the most important thing here, right?
Yeah. Sometimes you don't know until you experience. Maybe some people believe that, oh, I can take a 10% hit. But then when the 10% drawdown happens, then they panic, right? Some people think that they can take 20%, but they can't. And for aggressive investors who are thinking of what professional call sector rotation, that means you switch to defensive during a recession,
Got
then you
it.
switch to growth during the growth phase.
Yep.
And for that, you need to get the timing right very accurately, and not a lot of people can do it correctly.
Yeah.
So I would say that there is definitely risk, okay? But it is not impossible. It's just very challenging.
Yeah, it is challenging, and I think you need to do a lot of research and really know what you're doing. And if you don't, the safe path may be the boring path, but it's not always a bad thing. So a recession isn't always doom and gloom. Yes, it's a big R word, but it doesn't have to be a scary word. That said, if you harbor fears over your holdings as a recession looms, completely warranted. We totally get it. It's fine to be scared. But there are some bright spots that you can consider if you find the courage to let some light in. Thanks, Alvin, for coming into Money Talks and making us a little less afraid of an impending recession.
Thank you.
And thank you to you, dear listener. Did you enjoy this episode of Money Talks? Well, there's more content for you to enjoy and tune into. Just follow us on Apple Podcasts or Spotify. Give us 5 stars or leave a review. The team behind Money Talks is Jacqueline Chan, Joanne Chan, Tiffany Ang, Crispina Robert, Jesselyn Tan, and Saya Wind. And I'm Andrea Heng. Thanks for listening.